Hey everybody, this is Brent. It is Friday morning, June 24th, and I thought I'd do a quick little update. We got a little bear market rally or start of a bear market rally, and I just kind of want to go over the gist of what's going on because a lot has happened really over the last couple of weeks. By the way, bear market rallies are some of the most intense rallies you'll ever see. Spectacular rallies. Whether this has legs or not, we'll see. But I just wanted to kind of share with you what I've seen going on in the last couple of weeks. A lot of big changes as it applies to the Federal Reserve and what the market's outlook is on all that. So first of all, we got a live chart of the S&P 500. It's a 10-minute chart. And all this week, we've been kind of watching it bounce up and down here in this little bullish consolidation under 3,800, kind of like local resistance area. And then this morning it broke out. We did get some signals yesterday afternoon in 3C where we just saw some buying towards the end of the day like we haven't seen this week. That preceded this breakout this morning. This all has to do with changing perceptions about the Federal Reserve and their rate hike policy path and eventual cutting of rates. Just to be really clear, okay, we've got inflation out of control like we haven't seen in 40 years. Fed hasn't had to deal with any inflation since the early 1980s. And all last year, I've been telling my subscribers, look, if the Fed has to choose between inflation, which at the time the Fed was saying was transitory, it wasn't, it was embedded, and there were reasons we knew that in advance. If the Fed has to choose between putting the economy into recession to fight inflation or just try to support the economy and deal with inflation, they are going to put the economy into recession to fight inflation. So the inflation really largely came from COVID, supply chain shocks and all that stuff, and they can't control that. But when they pump trillions of dollars into the markets since the March 2020 COVID lockdown, they're exacerbating inflation. So what the Fed has decided to do is basically try to kill demand by raising rates, and we're seeing that happen in housing now. I think the average 30-year mortgage started the year at something like 3.1%. It's now like 6.1%. So if you bought the median house, I think it's around $350,000 with a 30-year mortgage, it's 40% more expensive now than it was at the beginning of the year. So that's really what they're trying to do, is kill demand to try to kill inflation. Then once they think they have inflation under control, they'll deal with the recession by cutting rates and buying QE assets, quantitative easing like they've done for 2 decades. But what I want to show you is how much has changed over the last couple of weeks. So let me go to the 10-year yield. And here's a 60-minute chart of the 10-year yield. You can see we had this little kind of head and shoulders kind of little thing going on here because in April we had a CPI inflation report that kind of seemed to suggest maybe inflation was peaking, but the market wants to see 2 months of that. So we had this kind of little head and shoulders thing over here. And then right over here, we got the May CPI report, which was much hotter than expected. So that killed the market's hopes that inflation might be peaking and the Fed can, pump the brakes on rate hikes and all that. And then we saw the market price in basically about, the 10-year yield price in almost 50 basis points from that CPI report right here, priced in a much more aggressive Fed. The Fed was supposed to hike rates by 50 basis points at the June FOMC meeting. They went with 75, largely because of that really hot CPI report that was right here. But notice what's happened in the last week or so. The 10-year yield has come all the way down and retraced all of that hot CPI report. So all of a sudden, perceptions are changing a lot. Part of that is we got really bad global PMIs. Europe was like horrendous. I think Bloomberg called it a horror show. The US PMIs were bad. So it shows the economies, global economies, US economy moving into recession if they're not already in recession. And that was the Fed's goal. It's not their stated goal. They don't want to come out and say that, but that is their goal, to kill inflation, put the economy into a recession. So what's happened over here in the last week and a half or so, as the S&P 500 has been trading right around, just under 3,800. Well, this is one of my favorite macro indicators. And what it is the copper to gold price ratio here in red. and then the 10-year yield. So if you look back to like March of 2021, sorry about that, March 2020, we had the COVID crash. You could see that the 10-year yield was trading around 1.5%, and the copper gold ratio was saying major inflation. This is not transitory. This is over a year ago that the commodity market got it. The Fed didn't get it. The bond market didn't get it. And what this ratio was saying was that the 10-year yield should be trading about twice as high as it was at the time, around 2.8 to 3.0%, which it eventually did. It took a little while, took this year for it to catch up, caught up real quick, and maybe overshot here. And why overshot? Well, we're talking about that hot CPI report, right? That big 50 basis point move in the 10-year yield. So my opinion at the time was, I think rates have overshot. I think the market is priced in too much hawkishness on the part of the Fed. Not to say they're not hawkish, but too much after that CPI report. Then we've been watching this copper gold ratio for signs that inflation may be peaking. And the commodity market over here picked up on it well before they picked up on inflation, that it was not transitory, well before economic data did, well before the bond market did, and well before the Federal Reserve did. Well, what we got this week was the copper gold ratio breaking down, which suggests rates here are still too high and that they need to come down. And when they come down, generally speaking, the very heavily weighted mega cap stocks do well. When rates go up, they don't do well. Now, why has the copper gold ratio broken down? Well, like this month alone, copper has fallen about 20%, crude's fallen about 15%, lumber has fallen almost 18%. In almost any other time, if it wasn't an inflationary environment, those would be warning signals to me that we're in a deflationary spiral, which generally means we're heading for a recession, which means we are anyway, but that's what the Fed wants. The Fed wants inflation to come down via a recession. So this was a really interesting signal this week, this copper gold ratio breaking down below trend. And again, that has to do with commodities coming down sharply. Maybe it's the Fed driving speculators out, whatever. It's still a huge and really significant move. So I suppose you could say that between that and these horrendous PMI reports showing global economies going into recession, all of a sudden the market is now pricing in a much lower or shallower Fed rate hike path, and basically kind of saying, we think you're going to be done by September, which comes right before the midterm elections. The Fed doesn't want to be seen as meddling in midterm elections, so they may take a pause, and they may say, we want to assess monetary policy because monetary policy has a lag, so they may do that. They may take that pause. But the market right now went from a couple weeks ago saying the Fed needs to be much more hawkish and raise rates much quicker to now saying, well, we think you're going to be done in September, and in 2023, we think you're going to be cutting rates to clean up this recession that you've caused. And in my opinion, although we've been seeing some signs here of a potential breakout coming, I think that is what the market is responding to here. Now, keep in mind how much things have changed in just a couple of weeks, from the market saying the Fed needs to be much more aggressive than it is because of that hot CPI report, to now saying, well, we think you're going to be done hiking rates in September, which is not the Fed's guidance. Of course, it wasn't the Fed's guidance to hike as hot as the market had priced in before the June FOMC. So this is some of the stuff, that you see in bear market counter trend rallies. The market thinks, oh, it's over, and we have this massive rally, and then it's not, and things change quick, and we hit new lows. So that all remains to be seen. But I think one of the most significant signs, though, is that copper gold ratio coming down. That's not a day trading signal. That's not like even a weekly signal. That's like a macro economic signal. So that's a pretty big thing that happened with that coming down. And the gist or takeaway is it may be saying that inflation is peaking. The only reason the Fed really wants to affect a recession is to kill demand, to kill inflation, because inflation is a much trickier problem for them to deal with than a recession is. Recession, they have to cut Fed funds rate usually by 500 basis points, which they don't have, so they've been buying assets, QE, to make up for that. the last time we had real inflation, the Fed took the Fed funds rate up to something like 19% in the early 80s. That's a lot. So it's much harder to kill inflation than it is to deal with a recession. So we'll see if this rally has legs. The market was really deeply oversold. The most oversold it's been this year on some of my breadth indicators coming into this. But there are a lot of zones of potential resistance here. You can see we're dealing with the first one right about the bottom of this gap. This, by the way, is that kind of CPI gap and bear flag here, and then coming down. Here's the FOMC, the knee-jerk reaction. And one of the reasons I thought, we might get some kind of little bounce or rally here, not just because we're really deeply oversold, but because the measured move over here was not met. And when measured moves aren't met, that is typically, in this case, would be a bullish scenario, and typically leads to a reversal. If they're not met on the upside, like we saw with gold earlier in the year, then that's a bearish signal. So in any case, we do have a lot of gaps up here. These are going to be resistance. We have this level up here. So there's still a lot to chew through, and things change quickly. But I just want to give you a heads up on kind of what is going on, broadly speaking, with the market, how things have changed so quickly. And again, this is kind of typical of a bear market. So let's see where all this goes. I hope you found it helpful in understanding what's going on. Check out the website, come visit us, see about subscribing. If not, click the video, like it, subscribe to the videos. I'll be doing more of them. Have a great weekend, everybody.